When I say there's only one investing rule you need after 50, I'm not trying to be dramatic. I'm telling you the truth. I learned over nearly a century of watching people either build wealth or destroy it with their own hands. The world loves complicated strategies, exotic investments, shiny trends, and clever theories. But after 50, none of that matters. You don't need brilliance. You need survival. Let me start with an unpleasant fact. Once you hit 50, your biggest opportunities are behind you and your biggest dangers are in front of you. I don't say that to depress you. I say it so you stop lying to yourself. Your career is mostly set. Your income is relatively predictable. Your risk tolerance has shrunk, whether you admit it or not. You're not a 25-year-old with decades to recover from stupidity. You're someone who must protect what you've already built. And yet, I've watched more people destroy their financial future after 50 than before it. Why? Because they panic. They feel behind. They try to catch up in a hurry. That's when disaster arrives. Let me give you a line I've repeated for decades. After 50, your job is not to get rich. Your job is to avoid getting poor. People in their 50 seconds make the same mistake every generation. They try to compensate for lost time by taking risks that would have made sense at 25 but are suicidal at 55. They chase hot stocks, speculative startups, crypto bubbles, or real estate schemes promising double-digit returns. They throw money at noise because they're scared of silence. They confuse urgency with wisdom. I once knew a man, smart, respected, wealthy enough, who decided at 52 that he was falling behind. He dumped a large chunk of his retirement into some energy stocks his friends bragged about. When the market turned, he lost nearly half. Not because he was stupid, but because he couldn't stand the idea that someone else was getting ahead. That's the real poison. After 50, envy, dressed as urgency. Look, I grew up during the Great Depression. I saw people lose everything because they believed the good times would last forever. They were wrong. Then I saw people lose everything again because they believed the bad times would last forever. They were wrong again. The pattern never changes. The stupidity just changes clothes. Let me tell you the only investing rule you need after 50. Play defense. Relentlessly. Aggressively. Without apology. Defense means staying solvent, not being clever. Defense means boring investing, not exciting gambling. Defense means avoiding what can wipe you out, not chasing what can impress your friends. You don't need high-risk growth. You need durability. You don't need leverage. You need liquidity. You don't need complexity. You need clarity. People hate that advice. They want magic. They want shortcuts. They want to believe they're one trade away from a miracle. But miracles are rare, and stupidity is common. I tell people all the time, at 50, your goal is not to beat the market. It's to make sure the market doesn't beat you. Let me illustrate something simple. If you lose 50% of your money at 30, you can recover. You have time, energy, income, decades of compounding ahead. If you lose 50% at 60, you may never recover. You don't have the time. You don't have the compounding runway. You don't have a second shot. That's the quiet horror people ignore until it's too late. When you're 20 or 30, taking risks might be wise. When you're 50 or 60, taking risks is usually delusion disguised as confidence. One of the great tragedies of investing is how many people reach their late years still thinking like gamblers. They assume they can outsmart professional traders, hedge funds, algorithms, and people who do nothing all day except stare at screens. Meanwhile, they're juggling work, family, health problems, responsibilities, and still believe they can beat the game. You won't. Not at 50, not at 60. The market doesn't care how smart you think you are. What the market does reward is something almost nobody practices. Boring, durable, consistent rationality. People laugh at boring portfolios until the crash comes. Then they stop laughing. I've watched boring portfolios survive every recession, every crash, every bubble, every mania, They don't make headlines. They don't brag. They just compound quietly, relentlessly, and without drama. So what does playing defense actually mean? It means low debt or no debt. It means simple investments you understand. It means avoiding speculation completely. It means sticking to businesses that make money in good times and bad. It means resisting envy when everyone else chases shiny objects. It means remembering that survival beats brilliance every time. Because after 50, brilliance is overrated and stupidity is fatal. In the next part, I'll explain how to build a defensive strategy that still grows, but without risking your future or your dignity. Let's talk about what playing defense actually means after you turn 50, because most people get this horribly wrong. They think defense means being passive, timid, or fearful. That's nonsense. Defense is not weakness. Defense is strategy. Defense is survival. Defense is how you make sure the next 20 or 30 years of your life don't become a financial disaster. Let me start with a principle people hate to hear. After 50, your biggest enemy isn't the market, it's your own behavior. You don't blow up because of interest rates, inflation, recessions, or politics. You blow up because of impatience, envy, panic, and the delusion that you can catch up fast. The most dangerous investor in the world is a scared middle-aged person trying to make up for lost time. They jump into crypto at the top. They chase tech stocks they don't understand. They believe salesmen promising guaranteed high returns. They listen to friends bragging about their portfolios and think, why not me? I'll tell you why not you. Because you don't have the time to recover if you're wrong. When you're 25, a stupid mistake is a lesson. When you're 55, a stupid mistake is a catastrophe. This brings me to the first defensive rule. 1. Avoid anything that can take you to zero. Not low probability of loss. Not high reward, moderate risk. No. I'm talking about investments where the downside is total annihilation, leverage, speculation, exotic financial products you don't understand, startups that sound exciting but burn cash, real estate deals promising 20% returns with borrowed money. These are weapons of financial mass destruction, especially for anyone over 50. You can't rebuild easily. You can't restart the compounding clock. You can't bounce back with decades ahead of you. At 50 plus, staying in the game is more important than winning the game. 2. Simplify your investments until they're boring. People hate simplicity because it doesn't make them feel smart. They want complicated charts, clever strategies, secret tactics. But after 50, complexity is poison. If you can't explain an investment to your spouse in 60 seconds, you shouldn't own it. If you need a PhD to understand the risks, you shouldn't touch it. If it makes your pulse rise, that's not excitement, that's danger. The portfolios that survive crashes are the boring ones. Reliable dividend-paying companies, low-cost index funds, cash reserves, simple real estate that actually cash flows businesses with decades of stability. These aren't thrilling. That's why they work. Your goal is to build something that can endure hurricanes, not something that looks fashionable on CNBC. Number 3, keep a margin of safety so large it feels excessive. People underestimate how fragile life becomes after 50. Health problems appear. Income becomes less flexible. Opportunities shrink. Responsibilities grow. That's why your margin of safety must be bigger than you think. Cash isn't dead money. Cash is survival. Cash is peace of mind. Cash is the thing that keeps you from making stupid decisions under stress. A person with savings can wait. A person without savings panics. And panic is the financial cancer of middle age. 4. Own assets that don't depend on you showing up. At 50, you cannot rely on your ability to work forever. Your energy drops. Your health becomes uncertain. The treadmill eventually throws everyone off. So your investments must be able to function whether you're present or not. That means dividend stocks, index funds, rental properties with managers, royalties, business stakes that earn while you sleep. If your income stops the moment you stop working, you're not investing, you're just extending your job. You must transition from labor to ownership before it's too late. Number 5, stop trying to impress anyone. Let me tell you something harsh. Envy destroys more wealth after 50 than recessions do. People don't go broke because they earn too little. They go broke because they can't stand seeing someone else earn more. Your neighbor buys a new car, so you think you need one. Your coworker doubles his money in some ridiculous scheme, and you feel behind. Your friend brags about crypto profits, and suddenly your stable investments feel boring. This is how people in their 50 seconds sabotage decades of disciplined saving by trying to catch up to illusions. Nobody posts their losses on social media. Nobody brags about going broke. Nobody announces when their portfolio collapses. You only see the highlight reel. Comparing yourself to that is financial suicide. The truth you must accept. After 50, wealth isn't built by brilliance. It's preserved by discipline, simplicity, and stupidity avoidance. People want magic formulas, but the formula is brutally simple. Spend less than you earn. Avoid debt like the plague. Buy what you understand. Hold it long enough to benefit from compounding. Ignore the noise. Stay in the game. Most people can't do that, and that's why they stay broke. If you want to understand why most people fail financially after 50, you need to accept something uncomfortable. Your age increases, but your impulses don't. Your hair gets gray, your knees get stiff, your back hurts, but the part of your brain that wants excitement still thinks it's 25. That mismatch ruins more retirements than recessions ever will. Most people hit 50 and imagine they're wiser, more rational, more grounded. But time doesn't automatically give you wisdom. Time only gives you consequences. And if you've spent your entire life making emotional financial decisions, you're not wiser at 50, you're just closer to the cliff. A truth most financial gurus will never tell you. After 50, your financial success depends almost entirely on your ability to avoid emotional decisions. Not on brilliance, not on picking winners, not on secret strategies, on emotional control. Because the older you get, the more destructive one bad decision becomes. At 30, you can lose half your savings and recover. At 60, one wrong move can destroy the next 25 years of your life. This is why I insist that defense is the only rule you need, and in this part, I'll explain the psychological traps that destroy people after 51. The catch-up panic trap. People reach midlife and suddenly feel behind. They compare themselves to their friends, their siblings, their coworkers. They look at someone else retiring early or bragging about stocks or buying a second home, and they panic. They think, I need to catch up quickly. That single thought is responsible for more bankruptcies after 50 than any stock market crash. It pushes people into risky investments. It makes them trust the wrong people. It makes them believe in shortcuts that don't exist. Let me put it bluntly. At 50, trying to catch up fast is the fastest way to fall even further behind. Wealth built quickly is wealth lost quickly. Wealth built slowly is wealth that lasts. 2. The I'm smarter than the market trap. This one is deadly. People in their 50 seconds often have good careers, decades of experience, accomplishments, intelligence, and they mistakenly believe that translates into financial genius. It doesn't. You can be brilliant in your profession and stupid in the stock market. You can be an expert in your field and a complete amateur with money. The market doesn't reward IQ after 50, it rewards humility. Let me tell you something uncomfortable. The moment you think you're too smart to make a big mistake, you're about to make a big mistake. Overconfidence is a silent killer. It doesn't feel dangerous. It feels justified. But it blinds you to risk, blinds you to complexity, blinds you to consequences. Humility is the last free lunch in finance. Almost nobody uses it. 3. The envy makes me stupid trap. You want to know the biggest financial poison in the world? Not greed, not fear, not ignorance. It's envy. Envy destroys judgment. Envy blinds you to risk. Envy makes you take bets you know you shouldn't take. At 50 plus, envy becomes lethal because you no longer have years to correct your own stupidity. I've seen people live stable, disciplined financial lives for decades, only to destroy everything at 55 because they couldn't stand watching a coworker get rich on some flashy investment. They chase the same thing and lose everything. I've said it before and I'll say it again. Envy has ruined more portfolios than recessions ever will. 4. The one more big win trap. This one is tragic. People over 50 think, if I can just hit one good investment, one big home run, one lucky break, I'll be set. What they don't see is that this mindset is identical to that of a gambler walking into a casino. And casinos are not built for winners. At 50 plus, you are not supposed to be looking for home runs. You are supposed to be avoiding strikeouts. The difference between a comfortable retirement and a miserable one doesn't come from a big win. It comes from avoiding a big loss. A single disaster after 50 can destroy decades of discipline. 5. The noise makes me act trap. There is more financial noise today than at any time in history. Breaking news every hour. Market predictions every minute. Influencers shouting nonsense every second. Most people mistake noise for information, then they act on it. They trade too much. They panic too fast. They trust headlines instead of fundamentals. Here's a truth I learned long ago. Every minute you spend reacting to noise is a minute you're not thinking clearly. Good investment decisions come from silence, not chaos. The real point of part 3, if you're over 50, you don't need a new investment strategy. You need a new emotional strategy. Your job is to protect yourself from your panic, your envy, your insecurity, your ego, your impatience, your desire to catch up fast, your belief that you're smarter than the market. These are the enemies that ruin you, not recessions, not inflation, not politicians, not Wall Street. Once you defeat those internal enemies, the path becomes simple. And in the next part, I'll tell you exactly what to do step by step so your money can grow safely for the rest of your life without gambling, without stress, and without making the mistakes that destroy most people after 50. So far, I've told you the dangers, the traps, the psychological landmines that destroy most people after 50. But now we get to the part everyone wants. What should you actually do? What does playing defense look like, step by step? Let me disappoint you before I help you. There is no magic trick. There is no secret formula. There is no shortcut. What you need is simple, painfully simple, but almost nobody has the discipline to follow it. And that's why almost nobody becomes financially free after 51. Build a portfolio that can survive a disaster. The first rule is brutally straightforward. If your investments cannot survive a recession, they cannot survive you. Recessions are not rare events. They come like winter. Predictable, but people panic every time as if it's a surprise. Your portfolio should be boring enough, diversified enough, and sensible enough that you can go through a recession without touching it. That means high-quality index funds, stable dividend-paying companies, cash reserves, low or zero leverage. No speculative nonsense. The question is not how much can I make? The question is how much can I make? Much can I afford to lose without ruining my life? If the honest answer is not much, then your portfolio must reflect that. 2, shift from growth to durability. People in their 20 seconds chase growth. People in their 50 seconds need durability. Growth is exciting. Durability is dull. But dull is what keeps you alive financially. I'll put it bluntly. An average investment held for decades beats a brilliant investment held for months. People lose fortunes not because they bought the wrong thing, but because they couldn't sit still long enough to benefit from compounding. Compounding works slowly, then suddenly, but only if you let it. At 50 plus, you're not trying to double your money every year. You're trying to avoid cutting it in half. 3, hold great businesses and ignore the noise. One of the greatest lessons of my life is this. If you find a genuinely great business, sit on your ass and hold it. Not for a week, not for a year, for decades. People over 50 ruin themselves trying to outsmart headlines. War, elections, recessions, inflation, all noise. A great business survives. A great business adapts. A great business compounds. It doesn't matter if it's not exciting. Excitement is for children. Durability is for adults. 4, cut out the 3 poisons. I've said this 1,000 times, but people still don't listen. Debt, drama, dumb people. These 3 destroy more wealth after 50 than anything else. Debt makes you fragile. Drama distracts you from rational thinking. Dumb people pull you into stupid decisions that take years to unwind. Your life after 50 should be a fortress, not a circus. If someone brings chaos, distance yourself. If an investment depends on perfect timing, avoid it. If a deal sounds too good to be true, it is. Boring wins. Calm wins. Discipline wins. 5, live below your means radically. Here's something nobody wants to hear. If you spend more than you earn, I cannot help you. No one can. Warren Buffett. Not the stock market, not the economy, not luck. Arithmetic wins every time. People earning 6 figures go broke because they live like geniuses and invest like idiots. People with modest incomes retire comfortably because they live simply and invest steadily. Your financial life after 50 is determined by this single equation. What you don't spend becomes what saves you. If you want independence, freedom, peace, it starts with restraint. 6, make your future the priority, not your ego. Most people in their 50 seconds don't fail financially because they're poor. They fail because they keep trying to look rich. New cars, new gadgets, new vacations, new status symbols, all bought on borrowed time and borrowed money. Let me put it plainly. Trying to impress people is the fastest way to stay broke. Your neighbor's opinion won't pay your bills. Your friend's approval won't fund your retirement. Nobody remembers the things you bought, only the mistakes you made. Live quietly. Live rationally. Let compounding make the noise for you. 7, build a life that doesn't depend on hope. Hope is not a strategy. Luck is not a plan. And desperation is not a financial philosophy. A great retirement is built on consistency, patience, rationality, simplicity, self-control. Not brilliance, not risk-taking, not prediction. The older you get, the more important it becomes to rely on the things that always work, not the things that might work. Slow money becomes big money. Big risks become big regrets. The final lesson. If I had to reduce everything I've learned over 99 years into one truth for people over 50, it would be this. Asterisk, asterisk. You don't have to be brilliant to get rich. You only have to stop doing stupid things long enough for compounding to work. Asterisk, asterisk. Avoid debt. Avoid drama. Avoid envy. Avoid speculation. Avoid impatience. Avoid noise. Avoid complexity. And above all, asterisk, asterisk. Stay in the game. Survival is the real victory. Asterisk, asterisk. If you do that, the only investing rule you need after 50 will take you farther than you ever imagined.